Welcome back to the show. This week, I have the pleasure of hosting two macro masterminds. I love following them on X and watching all their interviews. We have Danielle DiMartino Booth, CEO and Chief Strategist at QI Research, and Jim Bianco, President and Macro Strategist at Bianco Research. Thank you so much, both of you, for joining me.
Great to be here today.
Well, we got some inflation news this week, so why don't we just start there? The print, 3.1%. We're coming down. Danielle, I'll actually kick it off to you first because I know that you've been tracking data points like truflation, which apparently says that inflation is actually at 1.39%. So why are these two numbers so different, and what's your take?
Well, it was fun for us because the founders of truflation handed us the raw data. Going back to January of 2012, we were able to run a full correlation, and we've run that about 3 times here, I want to say, in the last 12 months or so. Steady as she goes, 0.97% correlation. It's probably the best look into out over the horizon view of what it's going to be. They're constantly adding new inputs. They added hotels a few months ago, and that was actually when they gapped down. And then more recently, they had a very broad base. 10 out of the 12 major categories took a step down, and that's what took them south of 1.5%. So they're seeing what we're seeing in real time. They're also going to reflect things like the average apartment in Nashville is now 4 months of rent for free. I know here in Dallas, it's more like 3 months of rent for free. You won't see that picked up in any official metric, but they'll get those nuances into their data based on what the actual effective rents are going to be. There's a lot less lag time, but I give headline CPI about 6 months, and we pretty much know where it's headed.
Well, Jim, I know that you on interviews have said that you think inflation is going to be sticky, 3 to 4%. So what do you think about that truflation number and what Danielle just said?
Well, I think truflation is a pretty accurate measure of where the inflation rate is going to go. The biggest difference between truflation and, say, the CPI is the weightings. The CPI has 40% of it in shelter, and truflation has 29% of it in shelter. In the other category, CPI has 3% and truflation has 12%. And a lot of that you can really break down the differences between the two by just how they weight and how they're putting the weightings in the measurements. The measurements themselves, I think, are fairly accurate. So when the CPI comes out and it's got 40% weighting and it says that year over year is like 6% and truflation's at 29% at 3.7% weighting, or 3.7% with a 29% weighting, that's pretty much most of the difference between the two measures right there.
Okay. You know, it's funny. A lot of the people listening or watching this, they think that they're being gaslit by their government officials. What they're experiencing in real life and at the stores doesn't match the numbers we're being told. Janet Yellen went before Congress last week, and she talked about how prices won't come down, but they don't have to because wages are up. Can you talk a little bit about that? I mean, are wages keeping up with this? Obviously, most people would say absolutely not.
Depends on the measure that you're using. But I would say, I would agree with most people that it's not. If you're looking at, and the administration likes to look at year over year, that it's gone from 9% in the middle of 22 down to the low 3s on inflation. And they're saying, look, it's come down. But I think most people are looking at prices are up 20 to 22% since 2020. And they're not coming down. And even the administration, whoever is the intern that is running Biden's Twitter account, basically tweeted out, well, it's gone from 9 to 3. Why are prices falling? Because they're still rising. They're just rising at a slower rate. Yep. And even Biden in the Super Bowl, when he talked about shrinkflation, again, he is implying that if the inflation rate goes from 4% to 3%, prices are still going up. He's implying with shrinkflation that they should be falling prices. Yep. They're not going to be falling. So that's where the disconnect comes in. But I think largely people are saying prices are up 20% since the pandemic. My paycheck isn't up 20% since the pandemic. That's what the average person is thinking right now. And that when you put the two together, that's what they think that they're seeing. This 4% to 3% or so, I don't think is really registering with a lot of people.
And Danielle, I know that you've talked a lot recently about jobs numbers, what were being presented versus maybe the adjusted numbers we're hearing, that a lot of them are coming through in the public sector, I believe like 25% as opposed to the private sector. And then within the private sector, it's like part-time or second jobs. So clearly, I mean, that doesn't reflect a healthy economy, yet we're being told by the administration that this is the healthiest economy we've seen in years.
Well, so I always try and fall back on my mentors, two older gentlemen who've been in the business about 50, 60 years. And, they're I'll paraphrase, they're not even pretending anymore. So the statisticians at the Bureau of Labor Statistics, they're not even pretending to understand what's going on with the data anymore. And the other big factor that is very real, right? Google reported a $2.1 billion charge for calendar year 2023. They went on to say that they would have $700 million in severance charges in the first quarter, ended the end of March. So one of the things that I'm discovering there's not data on, and I'm desperately seeking it, is the aggregate of what severance pay is. November of 2022, Amazon kicked off this white collar layoff cycle, 10,000 employees at its headquarters and it's in IT engineers. And Amazon's gone through 3 or 4 waves since then. But the white collar nature of the current down cycle, which would have normally in a plain vanilla recession started with the lowest paying workers who would never qualify for severance. But because it has, people get 3, 6, 9 months of good pay, depending on how long their tenure was with the company laying them off. So we have this massive kind of pig in the python effect it's beginning to come through. It's why we're seeing continuing jobless claims around 2 million, so stubbornly high. Last week, they just kicked over their 2019 levels. So we're finally starting to see some of the layoff numbers kick above and beyond, which is not good, where they were in 2019 when global trade was last contracting on an annual basis, which every time that's happened, the U.S. economy has slipped into recession. It slipped out of that potential, regular plain vanilla recession by virtue of 50% of GDP being pumped into the economy starting in March of 2020. And a lot of that continued on right through 2023.
I'd also throw in that when Danielle says, that they're throwing their hands in the air and they're not even pretending, a lot has changed in the labor market in the last 4 years. The biggest thing that we're all familiar with is remote work, and you can't overstate it. It is a tectonic change in the economy. Roughly 50% of the workforce can work remote. So that's 80 million people. 80 million people have to go to a place of employment to do their job, like a surgeon or a policeman or fireman or a carpenter. They can't work remote. But of those 80 million that can work remote, if you believe the Castle system data and some of the other data, they're at home 2 days a week or a day and a half a week. Now, pre-pandemic, we were home 2 days a week, Saturday and Sunday. We might be home now 4 days a week. That is a big change in your lifestyle. You are consuming different things and you are demanding different services because you're home a lot more than you did, say, in 2019. And that is changing the nature of the labor market, and that is changing the consumption patterns. And it is still something that the retailers, because of their ongoing inventory problems, are still trying to figure out. They know I'm going to come to the store. They know you're going to come to the store and we're going to buy stuff. They're not exactly sure what, because they knew what we were going to buy in 2019. They're not sure now because my lifestyle's changed. My consumption patterns have changed. And on top of that, what employees are learning is they have more power over employers than maybe any time in our lifetime. We saw that with the UAW strike. We saw that the Hollywood strike, the Kaiser Permanente strikes as well. We've seen this with labor negotiations, with the big wage increases that workers get. We see it with the terms that we're using: quiet quitting, labor hoarding. This is work for, I go to my boss and I say, I'm going to work 3 days a week in the office, 2 days a week at home. And my boss says, no, he wants me in 4 days a week. I say, I quit. I'll go find another job because I'm confident that I can. No less than the federal government. Last summer, the Biden administration tried to push DC federal workers back to the office 4 days a week. They had to relent on that because they all threatened to quit and they'd go find another job. So a lot has changed in the labor market post-pandemic. And it really starts with remote work. Final thing about remote work is that the numbers on remote work have been fairly steady now for about 18 months, around 2-ish days or so at home, 2-ish, 3 to 2.5 days or so on average in the office. And that ain't moving one way or the other, suggesting that this is kind of a permanent thing. And if it is a permanent thing, a lot about the labor market has changed that we still don't really understand.
Coin Stories is brought to you by Bitdeer, where the power of Bitcoin mining is at your fingertips. As a publicly traded leader, Bitdeer's global reach and scale means they're everywhere you need them to be, ensuring you're part of the thriving Bitcoin economy. Bitdeer's not just mining, they are industry pioneers, and Bitdeer stands alone as the only vertically integrated, technology-focused Bitcoin mining company. What does that mean? Well, they're not just deploying, but developing the latest tech to make Bitcoin mining more efficient and effective. With the industry's most experienced leadership team, innovation is in their DNA, and it shows, with a quarter of their workforce dedicated to research and development, pushing the boundaries of what's possible in Bitcoin mining. And now they're leveraging years of expertise in data center and cloud management into high-performance computing through a recently announced partnership with NVIDIA. Join Bitdeer in reshaping the world of Bitcoin mining. Learn more at bitdeer.com and explore how they are pioneering the future today. Well, and all of this speaks to the underlying weakness in the commercial real estate market, right? I think the bank term funding program's ending next month, right? Do either of you have takes on that and how it's going to impact the overall economy?
So I don't think that there's going to be too great of an impact. There are other outlets that preceded the bank term funding program, which of course capped out potentially when it was opened at $2 trillion. And now we've started to see it tick down now that they took that arbitrage away. Michael Barr was very quick to do that, and I take my hat off to him for that. But bigger picture, CRE, last week, Google laid off 3,700 some odd remote workers and replaced them with AI. And I think that when I was speaking to a group of multifamily investors a few days ago, the risk that I explained to them is that they could see office as a permanently impaired asset class. Even if we maintain, call it 50% of the gains that we saw in remote, there are so many companies, 1,000 employees in finance at Boeing, similar situation, Stanley Black & Decker in finance, offshored to India. AI, we don't know what it's going to be in the end. We're just starting to see companies have major AI replacements of individuals. But when it comes to CRE, I keep telling people that 2023 was not the crescendo. A lot of the savviest investors in office right now, like we saw with malls a generation ago, because you can only repurpose so many malls, put so many Halloween temporary stores in them, what have you. But a lot of really shrewd developers are saying, I want to know where that office building is and what the land underneath it is worth. If I'm not going to be able to repurpose this, and if office is permanently impaired, we're just not going to need as much going forward. And so I think is the stress is starting to flow into multifamily and even industrial. So I keep telling people that as bad as 2023 was, that 2024 is going to rival it, especially because big banks, if you're Jamie Dimon and you've got a corporate customer and he's got bonds to refinance, he's going to probably take that corporate customer before he takes the building, because there are so much more of a relationship. And, in small town America, small community banks, Natalie, around where you are in Missouri, around where I am in Dallas, a lot of these commercial real estate loans are full recourse. So I think that the trend that we've seen in fast rising personal bankruptcies, especially with buy now, pay later and people car repossession spiking, I think we'll see more of that, but actually attached to commercial real estate, which is frightening.
I agree with a lot of that. And I think, just to emphasize it, really CRE, commercial real estate, it's really about office right now. That is the big problem. And as Danielle said, there's an office tower near your house, near my house. What's that worth? Well, I had an idea what it was worth in 2019. And I think what we're starting to realize in 2024 is I don't know what it's worth. I just know it's not worth what it was in 2019. And the reason it's taken so long is for 2 years, we all held our breath. Oh, they're going to come back to the office. Everything's going to renormalize. It's going to rebalance. And now we're starting to realize, no, it isn't. Now, it's not worth zero. Maybe some of them are, but it's going to be worth some fraction of what it used to be worth. And as Danielle said, repurposing these office towers is going to be unbelievably expensive, if just not right doable. If you want to repurpose it into residential, it's all high end. It is so expensive to repurpose an office tower into residential. It's not going to be affordable housing. It's going to be high end luxury housing. Second of all, a lot of the the newer buildings, the newer office towers with the big footprints, the problem there is that no one wants to live residentially without a window. So what do you do with all the interior space? Mm-hmm. There's only so many Pelotons you can buy, and they're out of business anyway. To make gymnasiums on every single floor of this interior space. So it is a very, very difficult thing to try and get around office. Office was built on this cultural idea that we all went to a central location in a major city to do our job. And what the pandemic showed us is we don't necessarily have to do that anymore. And so it's leading the edge of a cultural shift away from that. And that's going to take many, many years to try and figure out what it means.
But with this industry so distressed and so many regional banks exposed to it, how does it not precipitate a greater credit event that would mean that the Fed has to essentially step in and stimulate?
Well, there's two ways I think you can answer the credit event. First of all, the top four banks, Citi, Wells, B of A, and JP Morgan Chase are about 75, 80% of assets in the banking system. Yes. And they are largely not in the commercial real estate business, except for the very, very huge office towers in Manhattan. But the rest of them, the other 4,000 banks, that's their bread and butter. That's why we have so many regional banks. So you can look at it one of two ways. This is a problem for the community and the regional banks. And the stock prices of community and regional banks have been horrible laggards. In fact, they're below their 2020 panic lows in some of the cases with some of those stocks. That if you bought them at the panic low in March of 2020, when everything was shut down, you're still at a loss, even though the stock market's at 5,000. That's how badly they've underperformed. So yeah, there's going to be a problem there. Is that going to be a system-wide credit problem? Well, 75% of the banks, are not really that exposed to it. And the cynical answer is, Jamie Dimon is sitting in his office tower at JP Morgan Chase, looking at all of these struggling New York Community Bank and everybody else going, your deposits will look good on my balance sheet because that's where they're all eventually going to wind up. So we'll have to see. So yeah, it's going to be a problem for the banking system, but the vast majority of the big banks are really not in this business. It's all the small and community banks.
Right. So it sounds like we're just going to be consolidating more and more into the too big to fail. Let's zoom out and just talk about recession, soft landing, no landing. I know, Danielle, you've said that the recession already started possibly in like October. Jim, I've heard you say maybe a no landing until something happens if they continue to tighten too long. So let's just hear it from both of you. What's your take on whether we're going to hit a hard landing in a recession?
My history is based purely on Bureau of Labor Statistics data that they started gathering state level unemployment rates in 1976. So when you look back in time when 50 or more states, 51 would include Washington, D.C. But once you cross that Rubicon of 50, and we ran the data down to the third decimal back to 1976, once you cross 50 states, you are in recession, or at least you have been 9 out of 9 times in the history. And we actually looked back the last time that there was job openings data released. We looked back at quits rates on a per state level. We looked at hiring rates on a per state level. We looked at firing rates on a per state level. And again, once you cross certain thresholds, you've been in recession. And we actually have in the late 1950s, we've seen the National Bureau of Economic Research come in when the unemployment rate was at an all-time low back then and actually date the recession starting in that month because other indicators that continue to get revised down to the negative. If you look at industrial production, it's been negative year over year for as long as the eye can see. So other arbiters of recession, according to the National Bureau of Economic Research, outside of initial jobless claims, which they don't use, but they do use the unemployment rate and they do use non-farm payrolls. But outside of these numbers that we're seeing serially revised, right? For all of 2023, private sector job revisions were negative for every single month. Have not seen that since 2008. But unless it's different this time, we should see this backdated to October of 2023.
Yeah, now this is one of the areas where we're going to disagree because I'm in the no landing camp, and I think that the economy is going to skirt a recession. As a matter of fact, if you ask me, I think the recession was 2 years ago when we had the negative quarters of Q1 and Q2 2022, back-to-back negative contraction GDP quarters. There's been 21 of them in American history, and only 2 back-to-back negative quarters of GDP have not been recessions, 1947 and 2022. And I think that was at a minimum the soft landing, but that was the recession that everybody looks at. But I think that, the strong data is going to continue. But before we, start the party balloons and stuff like that, hey, strong data, the economy's okay. My fear is that is going to keep inflation sticky. It's going to keep the inflation rate at 3%, if not, the high twos at the very most. Wall Street has this term that they like to use, the last mile of inflation. I think we've already walked the last mile. And I think that the inflation rate, I know we're at 3.1% on headline CPI. I think we could be there election day, still be at 3%, still not break 3%, that we're going to go the bulk of the year without breaking 3%. And then the reality is going to come in that this stronger than expected economy is going to lead to stickier inflation. And so that is the backdrop of this. But more to the point, like I said earlier, a lot of things changed in 2020. A lot of things changed in 2008. Whenever you have a major economic event, like a shutdown, restart of the economy in 2020, or financial crisis in 2008, coming out of it, things change. Change does not mean worse. But I think things have changed, and we're still struggling to understand what that change means. I think the guy that least gets it is Jay Powell. If you look at his press conference last week, I don't know how many times he used the terms normalizing, rebalancing, getting past the pandemic. He is of this opinion that what happened in 2020 was a temporary thing. It went away, and all the rules of 2019 are going to return to this economy, including 2% inflation and everything else. Well, let's just start with remote work. If you can't get everybody back to the office 5 days a week, it isn't going to be like 2019. And you cannot get people back to the office 5 days a week. So I think that the economy, because of those changes, has stayed a little bit stronger than people think. That's why I'm in the no landing camp. But I think the result of the no landing camp is going to be stickier inflation.
Can both of you explain something to me? When we talk about GDP, I've always been confused by that metric because, if we're spending a ton and driving up deficits, that's good for GDP, right? And if everybody's sick and they need healthcare and they're spending on healthcare, that's good for GDP, right? And then we also see a divergence between GDP and GDI, the income side. So I just want to get your take on this because we celebrate the number, but I feel like if you look under the surface, it doesn't necessarily mean that things are good.
Well, all I can say is that, again, this is a situation where you have to be excruciatingly, painfully patient. The difference between the establishment and the household survey when it comes to jobs, it's never been as wide as it is today. The difference between gross domestic income and gross domestic product, it's never been as wide as it is today. And we learn everything in these little nuanced revisions to business inventories. So that was the inventories that swung the GDP. They actually didn't occur. It comes out of GDI. So a lot of this has to do with patience, Natalie. I lean on the gross domestic income side of the equation, namely because it lines up with payroll taxes and withholding.
Which is negative, the income.
Yeah. And that's coming down. And that's what we're seeing with you're going to see withholding come down, even if people are on good fat severance checks and unemployed, because they're still making some money.
Well, and to your earlier point about the jobs numbers, I mean, if we lose one job that was a $250,000 salary, but replace it with 5 people at 50,000, it looks good on surface, right? 5 more people are employed, but they can't keep up with the cost of living.
Yeah, we looked back at the data. It was pretty fascinating because Zero Hedge came out, the National Enquirer of Finchwood. Zero Hedge came out with some graph that said, we haven't created a full-time job since February of 2023. I kind of went back to my team and I said, that can't be right. This has got to be scaremongering, fear tactics, blah, 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 blah. Let's look at this on a longer time frame and see what we're doing here. And it was interesting. So in January of 2024, full-time job growth was 0.7%, down from about 10% at the peak. And I looked back in December of 2007, when the economy was dated as being in recession, full-time job growth was 0.7%. We're 0.6% year over year today. My only point is we're actually below where we were in terms of creating full-time jobs. And again, in terms of the private sector in isolation, because 81% of the jobs created last year were in government social assistance, healthcare, to put a floor under that social assistance, leisure and hospitality. Those are a lot of low paying jobs. But because of that complexion, you have to sometimes look deeper. And right now, when it comes to full-time job creation, we've fallen down. And you had 700 and some odd thousand people drop out of the labor force, just give up looking for work here in the last 2 months.
Yeah. And a lot of people are hoping that they'll eventually get assistance, and student loans have been forgiven more and more. I know that it's an election year, so maybe we'll see some more interesting things. I want to talk about rates for a second, because cheap money is a deadly drug for an economy. And I get the impression, and I'm not a macro expert like you guys are, but that stocks are as high as they are, and we're seeing some of this divergence in reality versus the underlying factors. We see the S&P at an all-time high again, because people assume that the Fed is going to cut rates and maybe come back in with even the zero bound eventually. Like, there's this safety net, but also on the federal deficit side, they're spending. Uncle Sam is spending. Am I right about that? I mean, are we in this like falsely content space where we think that, oh, well, if something happens, the Fed will just step in and we'll be on QE infinity and we'll be fine?
Well, I'd argue to you that it's not falsely content, because that's what they do. Every time that something bad happens, whether it's shut down the economy, a financial crisis, a stock market crash in 87, they will print money, they will borrow money, they will throw money, they will mail it to you in order to keep you spending, in order to keep you keep you afloat. And for people to think, no, but the next crisis I'm on my own and I better retrench and I better be prepared for it. No, they're not going to. And so I understand, we have given a bunch of incentives, and that's what we've seen people respond to. But to your question about the stock market, the stock market's got a competition problem, and it thought that it got the competition problem resolved. And then it started to worry that it didn't get it resolved. Now, what do I mean? Dr. Jeremy Siegel wrote a new edition of his book, Stocks for the Long Run, last year. In the book, he says, what is the long-term return for the stock market? And he comes up with about 8%. And that sounds about reasonable. And some other people have similar types of numbers. So if you buy the S&P 500 index and you hold it for 5 years or 7 years, you should expect an average compounded return of about 8%. Mm-hmm. Okay, in 2019, when money market funds were at 0 and long-term bonds were at 2, you could scream the word Tina. There is no alternative. You're going to sit around and get nothing. You're going to have to put your money in the stock market. And there was this big flow into the stock market. Well, in 2023, that changed in a big way, because now the money market funds are giving you over 5%. Bonds are giving you in the high 4s. They're giving you, let me use money market funds because it's easier to understand. They're giving you 60 to 70% of the potential of the stock market with no market risk. Yeah. A money market fund is priced at $1 NAV every day. And for a lot of people, they're like, that's good enough. I'm getting most of the stock market, and doesn't matter what happens in the world, because that NAV will be $1 every day. If the NAV is not $1, it's the end of the world anyway, at that point. And so all of a sudden, the stock market's got this competition because of rates. through October of last year, if we go back to late October last year, everything was down in the stock market. The Max 7, the McGiff 7 stocks were up, but if you took those out, the other 493 stocks in the S&P were collectively down on the year. Small cap, mid cap, micro cap, down on the year at the end of October. They were having a terrible year. Then what happened beginning of November? We kicked off a giant bond rally and the stock market went ballistic. 14 of the last 15 weeks, the stock market has been up. And you have to go back 51 years to find another time that the stock market's done that. Why? Because the competition from rates has gone down, making the stock market look more attractive. And the Fed's going to cut rates, and everybody's been celebrating it. Well, let me fast forward and get a little short term. Today, the inflation report comes out a little bit more than people think. The bond market breaks out of its range to the highest yield that it's been in over 2 months. And the stock market is down 2%, or 100 S&P points as we're talking, because now higher rates is competition for the stock market all over again. So this is really why I've been critical of Wall Street, that Wall Street likes to forecast what it wants, not what it thinks is going to happen. What it wants is it wants lower rates. That's why a year ago they said recession. Then they said soft landing. Then they said last mile of inflation. And they keep everything that they come up with as far as the forecast goes leads to rates have to go down. And the stock market is sitting there going, I don't care if we have a recession. I don't care if everybody loses their job. I don't care if the economy goes to hell. Bring rates down so we can go higher. And that's all that they seem to be driving on, is that competition of interest rates. And if interest rates go up, even if interest rates are going up because the economy's booming, people are getting jobs, companies are going to earn money, they don't like that either, because that means that people just stick in the bond market. So it really is this yin and yang between interest rates and stocks. And, for the last couple of months or 15 weeks, the stock market's been celebrating that interest rate competition is behind us. And today now you're starting to see it worry interest rate competition might be returning.
It's time for another quick break to hear these messages from my partners. Next up, Bitcoin 2024, the world's largest Bitcoin conference, is coming to Nashville this year. Come join us for 3 amazing days of keynotes, panels, networking events, and my Women of Bitcoin brunch. The Bitcoin conference is where I launched my podcast almost 3 years ago. You never know what can happen or who you can meet here. Head to b.tc/conference and use the code HODL, HODL, for 10% off. Next up, CrowdHealth. Health insurance costs are sky high, and it's money that feels wasted if you don't need a doctor. By crowdfunding healthcare with other Bitcoiners, I get to avoid traditional insurance fees and support real people instead of mega corporations. CrowdHealth also works to reduce your medical bills, so the community's contributions cover more. Imagine spending just $100 a month on healthcare and investing the rest in Bitcoin. If you're interested, visit joincrowdhealth.com/Natalie. All right, back to the show. Well, Jim, to your earlier point, you've said that the Fed always steps in, especially if there's some sort of credit event or financial crisis. They have to step in and inject liquidity. Danielle, you have said you don't see it going back to the zero bound. So to both of you, I just want to ask, do you forecast in the next, let's say 2 years, 1 to 2 years, could we see interest rates close to zero again, or do you think they will be higher for longer?
Well, just to back up. So, Jay Powell was confirmed in May of 2022. So we've got, and on that day, he did an interview with NPR and he mentioned the 2% inflation target 14 times in that one interview. So we've got 3 more months here until he has actually stood his ground for 2 solid years. All we have to do is get past the March FOMC, and on a delta basis in terms of the amount of tightening and the length of tightening, he will, as of March of 2024, surpass Volcker's reign, which is quite incredible. But I think that his dot plot, I think you have to distinguish. This is Jay Powell's dot plot. Jay Powell's dot plot sees all the way out to infinity with nothing but a 2 handle on the Fed funds rate. If there's a credit event, all bets are off. And we got a little flavor for that in the last 10 days or so, because, there goes a Japanese bank. There goes a bank in Germany. There might be something contagious in commercial real estate holdings in foreign banks. But Natalie, this The days like today are catnip for him. And the S&P 500 being at an all-time high is more catnip for him. All he wants is to continue shrinking that balance sheet. He knows that the footprint's too big. He knows that the Basel III endgame regulations that he wants to push through, the time he leaves office in May of 2026, he knows that it's going to take that long. Michael Barr follows him in July of 2026. He wants for this massive seesaw to continue. Financial conditions ease, employment data, it disappoints to the downside, whether it's some specious non-farm payroll number or some BS top-line CPI number. He loves it all because he wants to stay higher for longer. He wants to continue shrinking the footprint of the Fed's balance sheet. He's got one facility that's got about $600 billion left in it and another $1 trillion worth of that. And he wants to find a way to slow the shrinkage of the balance sheet, but to stay at it for all of this year and into 2025. And in order to do that, it helps him if the stock market is at all-time highs. He already passed central clearing of treasuries. Google it. I know your viewers don't necessarily, their eyes just rolled into the back of their head. Hedge funds had to register after they passed the central clearing of treasury. That is the prerequisite for regulations that would change the world as we know it and make it a lot harder for the non-banking system, $250 trillion versus the conventional banking system, $180 trillion. If he pushes through with this, come what may, if it's Trump in the White House, God help him. It's going to be a painful last few years of his term. But if he pushes this through, he'll have a beautiful legacy.
Danielle, in one of your recent interviews, I heard you say that Powell was spooked and something was actually added to the minutes that they were thinking about tapering.
Tapering, yep.
Can you talk a little bit about what spooked him and what happened?
So I think there is something to be said for the fact that right now you can see the end of quantitative tightening. And we haven't been able to say that for a few years now, but you can see where that is going to eventually come to an end. And I'm hoping to speak to some Fed officials about tweaking the so-called Logan plan, and people should Google the Logan plan, but it dictates that the Fed can actually reduce the Fed funds rate while continuing at a slower pace to reduce the size of its balance sheet, which you would think these two would be kind of in competition with one another, effectively neutral monetary policy, never been tried before. But that is actually what we're contemplating here. But I do think that Powell is starting to get itchy knowing that there is going to be an end to quantitative easing. The clock is ticking. He might have had knowledge of New York City Bank Corp. He might have had knowledge of the Japanese bank having concentrated exposure to U.S. CREs back in late 2018. It was Japanese banks' exposure to U.S. collateralized loan obligations, which are kind of risky instruments, but some Japanese banks had up to 40% of their assets in them. And that was what actually caused the original Powell pivot back in late 2018. You can't hang up the phone on the Bank of Japan. You can't, who's saying, wait a minute, if you let this go, there might be systemic risk that's unleashed, and you can't do that as a central banker.
Wow. So what I find interesting is that they're trying to reduce the Fed balance sheet, but meanwhile, the U.S. federal debt keeps rising and rising. We're over 34 trillion right now. And I think that we've never had this bad of wealth concentration. And even the stimulus that was sent to the average American family, a lot of them spent it, and that helped the pockets of the very wealthy, right? It just like trickled up. So I wanted to ask both of you, is what the Fed is doing right now, is it helping fix the inequality that so many people feel? And how can this play out long term? Like, what would you do if you were in the position of Fed chair?
Fix the inequality. I mean, unless you are making the argument that we want to worsen it, yeah, that's what they're doing. They're not lessening it. The sad reality is, if you look at the Fed's consumer finance survey, 94% of all assets, stocks, bonds, real estate, retirement plans, are owned by the top 50% of income. So the bottom 50% only own 6% of the assets.
Yep.
But the bottom 50% have over 55% of the debt. Mm-hmm. So the unfortunate reality is the wealthy own assets. Yep. And their assets are going up. Stocks are at a new all-time high. No one's unhappy with the Zillow numbers that they're seeing on their home price estimates. And, bonds have an interest rate again, so they're getting cash flow. The bottom 50%, they don't own any of that stuff. They have personal loans. They might have a mortgage. They might have student loans. They might have credit cards and the like. And what they're seeing is a 20% rise in prices, a 19% rise in their income, and the borrowing costs are really, really hurting them. That's why it's showing up in the president's approval rating, and maybe not so much in GDP. The top half of the income are 85% of the spending in the United States. Mm-hmm. So they spend the money. The bottom half of the income, are not really spending because they pretty much live paycheck to paycheck. But one person, one vote is why the president's approval rating is down. So no, they're not doing anything about it. What they would need to do to help rectify that situation is they need to bring interest rates down. But to do that, they have to get inflation down. They can't cut rates for the sake of cutting rates. Quick story for you. In the summer of 2022, June, we hit 9% inflation. The Fed was raising rates 75 basis points a meeting. The 10-year yield peaked at 4.2%. In July of 2023, the Fed stopped raising rates, even though the inflation rate was at that point at 5 on its way down to 3, and the 10-year yield went to 5. Why did it go higher in late 23 than it did when we had 9% inflation? Because when you have inflation and the Fed is fighting inflation, the bond market's calm and it doesn't worry. But when the Fed stops fighting inflation and it's worried that there is inflation, yields go up. So I hear all this talk. Is Powell going to cut rates to help Biden? If he's got inflation and he cuts rates, he's going to elect Trump because he's going to wind up with higher interest rates. But if inflation goes away, he could do whatever he wants. He could go back to zero. He could do QE. But inflation has to go away. Now, as of the day we're recording, which is the day that January CPI came out, his measure of inflation, the CPI report, PCE report, it has not gone away by his measure. So he can't just cut rates, in isolation. He needs inflation to come down because if he cuts rates or threatens to stop raising them, like we saw in 23, interest rates could go up, and they could go up quite a bit.
It's going to be interesting to see how this all plays out, given that we're in an election year and a lot of people are ranking the economy as number one in terms of their concerns. A lot of people are really angry that they've seen this massive amount of wealth concentration over the last decade. The fact that we really are losing a sense of the strength of the middle class, the American dream. So how do you think, both of you, what do you think is going to happen given that it is an election year and it seems like they cannot allow for us to go off the cliff, right? Because that would be even worse, especially for the party that wants to stay in office.
Can I start by asking you a question, Natalie?
Sure.
Who are going to be the candidates on the ballot in November? Let's start with that.
I would love to know.
Yeah.
Right now, obviously, everyone thinks it's going to be Joe Biden versus Trump, but to be honest with you, I just don't see how Biden is on the ticket. I just don't know.
Right. And I agree with you. We say it, but I don't think a lot of people believe Biden's going to be on the ticket.
Right. There might be a switcheroo that happens. Maybe Gavin Newsom or Michelle Obama, though they've both denied it, right?
Right. Let's just, stick with politics. Let's just say the Democrat side is not Joe Biden, and forget who the name is. And that not Joe Biden person then starts pulling 20 points ahead of Donald Trump. Then you got a chance that on the Republican side, you might see not Donald Trump at that point. So I don't know, or maybe it is going to be Biden and Trump, or it's going to be Trump versus not Joe Biden, or some variation of that. But we don't know who is going to be the nominee. So it becomes very, very difficult to try and handicap the election. But I think to your larger point, a lot of people are very unhappy with the economy. Not only has it been about inflation and it's been about the squeeze of the middle class, but I'll get a little philosophical for you for 2 minutes here. You've got an 81-year-old guy running against a 77-year-old guy. And then I saw something during the Super Bowl, which I thought was amazing, was Robert Kennedy ran an ad, which was a John Kennedy ad from 60 years ago with his name superimposed on it.
Mm-hmm.
And it was generally perceived as being a very effective commercial. This country is not ready to go forward. This country is looking backwards. It was looking at an 81-year-old guy and a 77-year-old guy. And then the third party guy is going, remember my uncle from 60 years ago? Let's go back to that. We're all going backwards. No one is thinking forward. And I'll say it carefully because I don't mean it literally. Last time I saw this was the Soviet Union just electing one old guy after another in the 80s, and they kept dying before they eventually got Gorbachev and they started moving forward. I don't mean that literally, but I mean that they were afraid about what was coming next. I think we're in the same boat. And what I think is driving us in that boat is AI and technology. Goldman Sachs is out with a report that says that 300 million jobs are going to be displaced by AI in the next several years. Okay, I think that's right. But I'm also a believer in what Bob Gordon of Northwestern University says, and that is that technology is a net creator of jobs. So yes, we're going to lose 300 million jobs. We're probably going to create 400 million jobs. Those jobs we're going to create do not exist today. Those industries do not exist today. I can't tell you what they're going to be, but they're going to be created. I could tell you the jobs that are going to be lost. Did anybody know that we were going to create what we're talking about when YouTube came around, as far as, social media influencer and having that to be a revenue line for regular people? The fact that YouTube came into existence in 2006? No, but technology does that. And so I think a lot of people are afraid of what's coming in the future. They don't know. They know their current job, as they understand it, is at risk. They don't know what they transition into. Mm-hmm. It's a leap of faith for me to quote Bob Gordon and say, don't worry, there'll be something for you in that new brave world out there. But I don't know what it is. And I think that that's why we're all afraid. And that's why we're all looking to the past, and that we're not ready to find a young, dynamic leader that's going to take us forward to where we're going to go. And this is part of the real problem right now. Add to that inflation, add to that the uncertainty about the economy, add to that the instability of geopolitics and everything else. And I think that we're just in a very unclear, uncertain world. So long story short, this election is going to hinge on so many things that we don't understand. Least of all, we can't even name who the candidates are going to be at this point. That is going to be a very difficult thing to handicap as to what it means.
Lots of great points there, Danielle. I can't wait to hear what you think about this election. I know you've got some thoughts.
Well, I think on a practical level, given the 1.5 trillion last bit of stimulus spending went directly to your higher net worth individual, and it was all spent last year on services and traveling and going to the Champs-Élysées and everybody flying first class. So there's a greater recognition of that. If I'm the IRS in the year 2024, just for the sake of minimizing social strife, I'm going after as many of these fraudsters as I possibly can, and I'm doing as bright of perp walks as possible. Because they were on our TVs every other minute advertising, this free money is yours. Well, guess what? It really wasn't. But the reason I bring that up is because between now and April of 2025, there's a gulf of AI and the beginning of the AI getting rid of employees. You do one before you do the other. And in addition to that, you've got so many CEOs right now who are looking out for themselves and their shareholders. And that means who can lay off the most, which makes things even worse in a political year like what we're having. But right now, the GOP, Mike Johnson-led House of Representatives, all they're doing is keeping the lights on. Nobody's writing any major stimulus bills. The only money that might have come to households was going to go to the very lowest income earners in the form of a larger child tax credit. But that is not going to get you a line around Gucci. It ain't. It's just not happening. But so how we're advising our clients is depending on who's on those tickets. If it looks like you've got two big spenders or even a big spending Congress and Trump or Biden, right? They competed with each other just so you could spend more. Then we are going in for UBI 2.0. And come April of 2025, they'll be writing the checks all over again just to keep the social strife at bay. Because there's going to be a good chunk of Americans who are really angry if Trump wins. If that happens, there's going to be a huge chunk of Trumpians who are really, really angry if Biden wins. If, again, those are the two presumptive nominees. And I hope Jim's right. And I hope you're right, Natalie. We're all hoping that that's somebody else, that these truly can't be our only options as a country. But if it looks like we've got big spenders coming in, then for heaven's sake, short every bond you can find, because we were going back to double-digit inflation like that. Because
I would really like to disagree with you, Danielle, but I cannot. And that's my fear too, is that they're going to basically throw money at everybody that's just going to waste it. It's just going to be wasted money, and that is just going to produce more inflation.
I mean, we have the Hoover Dam, we have the Lincoln Tunnel, we have the highway system of America. What started with the New Deal, 40% of GDP over a certain number of years, at least we still have something to show for it. But 50% of GDP since 2020, and it was all pissed into the wind. That's the hardest thing to wrap your head around, and that's why we had such inflation.
So let me give you a stat, right? In 2020, and you probably know better than me, Danielle, what the average person got about $4,000 all in. I mean, in terms of stimulus money.
When the CARES Act was signed on an annualized basis, the average single working mother of two. So if she dropped out of the workforce, call it a home health worker here in Dallas, Texas, making $25,000 a year. If she had two children and she was not married, and she dropped out of the workforce on an annualized basis before the first stimulus check, this is net of the stimulus checks, $61,953. That was her income. She had no reason. Remember, Trump extended federal unemployment benefits through FEMA. He extended the rental eviction moratorium through the CDC. And he kept the student loan moratorium going. And that was just amplified by what Joe Biden did the minute he got into office. And that was a third stimulus check, the growing of the employee retention credit. But on day one that the CARES Act was signed, in March of 2020, $61,953. And we sit around and wonder why nursing homes don't have employees to this day.
Just to fill that in 2008, a lot of people forgot this, but we extended unemployment benefits and we did mail people money in 2008. It was a one-time check. It was like $25. It was $25. It was $25. So we went from $25 in 2008 to the next crisis, $40,000 we sent everybody. To the next crisis, everybody's going to be a billionaire. And then we're going to really see what inflation is going to be.
Natalie, you know where to come visit me, right? It's just... It's a single, look, I can make the euro sign. It's a single euro. You just have to fully renovate the villa. And, at least they call themselves socialists. So, but you know where to come find me. If any of these things happen, I don't want to sit around and watch double-digit inflation blow up in my country, even though I'll be shorting treasuries.
Well, I mean, it's just crazy because when you zoom out, hearing everything you're saying, and I agree with a lot of it, it's like we're watching a slow-moving decline of what was once a really great country, an empire, a superpower, but it's just continued to outspend what it can produce. And no matter who's in office, red or blue, they have to keep spending. I mean, that's just the way that the system is at this point.
So I'm gonna say something happy. I'd love to be able to maybe, and Jim, I didn't mean to cut you off. The founder of dailyjobcuts.com, he's become a friend over the years. And he reached out to me a few days ago. I saw this unsolicited direct message in Twitter. I'm like, oh God, it's going to get worse. Can it really get worse than January layoffs? And he said, I'm reaching out with good news. I have 4 solid examples of small businesses in small towns where the entire community has come together and kept the company on its feet and open. So Natalie, when we spoke for 3 hours in Vancouver, and we were looking for the good, it's all hope is not lost if there's still the American spirit.
Right.
That's what I have to, I mean, I rarely end anything on a happy note, but that's a super happy note if our communities are going to protect our small businesses.
I'll give you a happy note too. So I think ultimately I'll come back to what I said before. I think we're all looking at a period that is going to come of great change, and we don't know what it's going to be. And we're very, very scared. And like I went off on before about, we're all looking backwards because we're not looking to find a 40 or 45-year-old to say, lead us into this new era. I think part of the problem is that, people have said AI is going to be as big as the internet. That's true, but there was a big difference in 2000 versus 2024. In 2000, when the internet came around, it was presented to everybody as a bunch of tools. Here, Natalie, here, Danielle, here, Jim, you get these tools. You can create a website. You can do email. You can do anything you want with it. But now AI is being presented as you have to take out a subscription from a $1 trillion company. And then that $1 trillion company will tell you how to use it, will regulate how to use it, and will probably continue to charge you more and more and more for it. AI is never going to reach any kind of saturation level or success if I have to go pay Microsoft or Amazon a monthly fee to use it. But if it is presented to me like the internet was in 2000 as a bunch of tools, oh, I see these tools. I see opportunity with these tools. I can be creative with these tools. I don't have to sign up and then ask Microsoft's permission to do things with these tools. Then I think we could start to be a little bit more calm down, exhale about the future a little bit, and not be as afraid of it as we are right now. I think the way that the future is being being presented to us right now is there's 7 gatekeepers, and we have to go on bended knee to ask those gatekeepers permission to use these new tools. I think that's got a lot of people very, very nervous. But hopefully it's not going to be that. And it's going to be more like the internet itself. Here is an AI tool for you and me and everybody else to use. Go figure out what you want to do with it. And I think if we did that, we'd be a lot more optimistic about things.
Okay, so here's my last question to both of you. In this time of great change and in the environment that we talked about, I think hard, scarce assets are going to perform well. Talking even about the idea of maybe a new internet, something permissionless. I'm obviously a big advocate for Bitcoin. You both, I think you have very different takes on it, but how do you think Bitcoin will perform over the next 5 to 10 years? And what are your overall thoughts on it as an investment?
I'll go first because Jim's going to have a lot more to say. So I still consider it to be as a former central banker, a raw reflection of animal spirits.
I can't believe you're going to quote Keynes. I mean, come on. What will?
Oh, however you want to say it is. When the feeling is alive and you want to be long, then you want to be in Bitcoin first. It's the engine on the train of speculation.
What would get you to be more curious about Bitcoin or open?
I'm very curious about quantum computing, and I am very curious about the future of finance being available in different ways and delivered in different ways that takes the monopoly, the oligopoly banking system, the way that these things are delivered to individuals, kind of just liberating that for all. I think that's awesome. And I can't wait. And I'm sure that my children or grandchildren one day will teach me what to do with it. So I look forward. I've never poo-pooed the technology ever, nor will I ever. Because I think quantum is going to be a quantum leap.
Well, you are a Bitcoiner, you just don't know it yet. So Jim, what's your take?
So I'm gonna give a little bit more of a nuanced answer, which is largely going to agree with what Danielle said. Let me start off big picture. I am very optimistic about crypto, decentralized finance, Bitcoin as an alternative financial system. I think it's needed, and I think that they've got the right idea. And so the long term, I'm very optimistic about it. And now I'm going to shit all over it after I've said that. I think that I've been on record on this, and I'll say it again. I think the spot Bitcoin ETF is a giant mistake. And I think, yes, it will produce higher prices. Congratulations. Everybody, you're going to get 60,000 and you better be able to live off that for the rest of your life. You're not getting to a million. As a matter of fact, the spot Bitcoin ETF is an admission of failure, is what it is. You could never solve the UX problem. That's the user experience problem with crypto. You can't solve the problems with private keys. So you're giving up and you're saying, buy it in your brokerage account. You're sucking crypto into the current system is what you're doing with this. And you're celebrating that all the boomers are going to buy it through their brokerage account on a regulated product on the New York Stock Exchange. So Jay Powell and Janet Yellen could put and Gary Gensler could put endless rules on this thing and just completely lose the narrative for it. Look, like I said, you're going to get higher prices because you're going to suck in all of this speculative money, but you're going to get to a million because you innovate, because you come up with an alternative system, and you're not doing that. And worst of all, you're taking in all of the old saws that I've heard for 30 years with the gold market. Oh, if everybody puts 1% of their money in Bitcoin, it'll go to $500,000. I've heard that for 30 years. If everybody put 1% of their money in gold, and it never did anything. And the problem with gold is it was supposed to be a decentralized form of getting your money out of the financial system. And we sucked it into that with ETFs on gold and futures on gold. And we're doing exactly the same thing with Bitcoin. So I think what we're trying to do in the crypto space by creating an alternative system is good and is necessary. But I think we're giving up. Oh, it's too hard to build a new system. Let's just pump it to a bunch of boomers through ETF accounts and get all the wealth managers to put 1% of their money in it and give me 80,000 on Bitcoin and I'll be happy. Well, like I said, that's all you're going to get out of it. You're not going to get $500,000 out of it or $1 million out of it unless the adoption rate to the decentralized form of this and the adoption rate of an alternative financial system continues, whether it's ordinals on the Bitcoin blockchain, or it's DeFi on the Ethereum blockchain, or it's Jupiter on the Solana blockchain. We could argue about which is the best protocol, but that's the way we need to be going. But to me, this Bitcoin ETF is giving up. It's giving up. It's saying, you know, that terrible user experience that everybody has trying to figure out how to manage their private keys through a ledger and buy Bitcoin in a decentralized format. And maybe even Coinbase is too difficult to do. Well, I'm just giving up and we're just going to put it on the exchange. And Gary Gensler is going to be in charge of it, is really what's going to happen. So that's what I don't like. And yes, you're going to get higher prices over the short term. And the problem is the whole damn place is run by a bunch of degens, which is what Danielle was talking about, degen being a degenerate gambler, and that they are, all they want is number go up. They're not thinking bigger picture about what it is we're attempting to do. Because if you thought bigger picture about what it is you were attempting to do, you wouldn't be for the spot Bitcoin ETF. You would realize this is a sellout and it's actually going to make it worse in the long run. Now, I really want to be wrong on this, but I really can't see myself being wrong on this. Oh, $3 billion has gone into the Bitcoin ETF and it's been a big success. Gary Gensler runs that stuff. He's going to put rules on you. He's going to tell you what you can do with it. And then one day, like they did with gold in 1934, he's going to turn to you and say, you know, those millions of dollars that you have in Bitcoin spot ETFs, they're now worth nothing. They're banned and your money can never come back to you again. That's what we did with gold in 34. And that's what we're risking with this, with the spot Bitcoin ETF. You have to build an alternative system, not suck it into the current system. And so that's why I'm of mixed emotions about this. I really like what we're trying to do. I just really wish that we would. And then the worst part about it all is it was Larry Fink that drove this whole thing, Mr. Current Financial System himself, and that everybody signed up with him in order to say, yeah, I agree with Larry. Let's go that route. So that's where I'm at. Tell me I'm wrong. Tell me that everybody's going to buy Bitcoin and we're going to get this. We're going to get everybody to spend money on wonderful innovations at the same time. They're going to give up on the innovations and they're just going to chase higher prices in their ETF accounts. That's what I'm afraid of.
Well, Jim, you bring up some really interesting points. I mean, I see the spot Bitcoin ETFs as being accretive and another avenue to spur more adoption. But the fact is, Bitcoin has an addressable market of 8 billion people. And there are a lot of people in a lot of countries where their fiat currencies are more volatile than Bitcoin, and they're turning to it as a life raft. And I don't think that the ETFs take away from that. Now, do we have challenges ahead? You raised the point about potentially an executive order 6102 2.0, right, where they banned private ownership of gold. Some people are worried that they're not going to allow you to self-custody your Bitcoin, and you're only going to be able to have it in some regulated securities or what have you. But I think that the future is bright in the same way that eventually the pushbacks to even the early internet and encryption, eventually the public won, because at the end of the day, code is speech, right? We want to push for free speech, and we do want that decentralized system.
Are we? Because I agree. Code is law, and that we want free speech, and that's why I'm a big fan of it. But is that what we want? Because that's what you're not getting in a regulated brokerage account buying a spot ETF. That is what you're not getting. You're giving that up. You're giving that up.
Every single word he said just now, by the way.
Yeah, no, and the good thing is, at least for now, all of us have the choice to buy spot Bitcoin or one of these ETFs. I think everyone in my audience knows which one I'm buying. But it's been so great to talk to both of you. I know we're running overtime, so just any final thoughts and where people can find your work.
Mine is on my ledger right here. No spot ETF for me.
Oh, there you go.
Yeah.
As far as I'm concerned, I am a research house, independent research. So come to dmartinobooth.substack.com. Natalie, I've got a lot of your regular viewers as clients. I couldn't be any happier. And of course, as long as you're not a bot or a troll, follow me at DiMartino Booth, please. Nicely.
And I will link to both of your research firms. Thank you so much for taking the time. I love hearing all of your insights. Thank you for everything you do, and hopefully we'll see you again soon.
Thank you.
Thank you, Natalie.
This show is also brought to you by iTrust Capital. iTrust lets you invest in Bitcoin for your retirement with the tax benefits of an IRA. If you're doing retirement planning and considering adding Bitcoin to your portfolio, you can sign up for an account and get a $100 bonus at itrust.capital/Natalie Brunell. Thank you so much for checking out this episode of the Coin Stories podcast brought to you by Bitdeer. Make sure you're subscribed so you don't miss out on any new content. This show is for educational and entertainment purposes only. Nothing should constitute as official investment advice, and you should always do your own research. My inbox is open if you want to share feedback or guest suggestions. You can reach me at Natalie@talkingbitcoin.com. I'll see you next time.